Hello friends, this is Raj Sastry from Raj Option Trading. Today is March 22nd, 2022. Let's take a look at one of my favorite strategy, especially when the market is choppy and volatile. It's selling put options. So it's an income strategy. Think of this way. You got a portfolio of maybe say $200,000 or $500,000 and you got a lot of good stocks and you got a lot of buying power and you don't know what to do when the market is volatile. So one of the best way to take care of the volatile market is to sell put option. So as a seller of a put option, you will make money if the underlying stock increases in price, stays the same, or decreases slightly. So as long as it stays above the strike price, you'll make some money. So that way, think of this way: your broker is giving you some free money to really sell some put options and earn some premium. The key thing is really don't overdo it. Do it slowly so that way you don't use up all your buying power. So with that, typically, when you want to sell put options, your outlook is bullish. So you want the stock or the ETF to go up, and risk is theoretically unlimited, but typically it's not unlimited. It's a strike price less the premium that you received, and maximum reward is limited to premium you received. That's why I say don't overdo it, because your profit potential is limited to the premium you received. You would rather balance this strategy with your growth strategies, like buying the stock outright when the market drops. And this can be combined with the other position. As an example, you want to sell put option in Tesla, which is a maybe around $900 stock. You might want to do a spread, or as sell a vertical spread instead of put option itself. You can look at those strategy also. And generally, sell only when the IV percentile is high. One of my favorite strategies is when the market drops big time, like yesterday afternoon. That's the best time to sell some put options in your favorite ETFs like SPY, QQQ, IWM, SMH, and so on and so forth. And you need to identify a clear area of support. We'll get into this also. So that way you are above that area of support, or you're actually slightly below the area of support, or at the area of support when you sell put options from a strike price perspective. And typically, you want to go at the most 45 to 60. And then when the market is very volatile, like these days, I typically go maybe 30, 35 days. So you get good premium. And passage of time, or theta, decays your friend. So as time passes by, when the stock is above the strike price, you make good money. It kind of decays, and you keep earning more and more money. And typically, make sure the probability of touch, meaning the price touching your strike price, is around 30%. So that way, you don't overly expose yourself to the jittery market. And avoid the stocks with a heavy debt. It's not your worthwhile. You're not trying to make a big amount of money. You're just trying to stay above the market and make some money to really go above and beyond the normal indices like S&P 500 and so on and so forth. That's why avoid the stocks, the heavy stock debt, avoid the stocks which draw down heavily, and go after the big dogs, as they say. All right, so with that, let's jump in here and look at when to sell and when to not sell put options. Typically, when you want to sell put options, best time is after the negative earnings news, earnings miss, FDA rejection, and also like yesterday's news. Jerome Powell, our Fed chief, said inflation is too high, and he got to say take some necessary steps. Market drops off. That's the best time for you to sell some put options. When there's a macro news like Jerome Powell saying he has to take necessary steps, I would sell some put options on these major ETFs like SPY, QQQ, SMH, and so on and so forth. That's the best time to take advantage of macro news. But your favorite stock like Facebook or Apple or NVDA, AMD, they had some bad news, maybe a negative earnings news. That's when you sell put options on those stocks. I would stay, with the big market cap stocks and big ETFs, so that way you don't expose yourself. You're trying to earn a premium here. You're not trying to, make too much money. It's one of the conservative income strategy. And also go after the growth stocks with the temporary weakness, and sell put options on your favorite ETFs like you're talking about. When there's a big macro news, market drops off, maybe say 200 points, 300 points. One of my favorite strategies to sell some put options on QQQ, SPY, XLV, and so on and so forth. These are very stable here. You can stay at very very low price strike when it comes to these ETFs, and still make some good money. And don't be afraid of option assignments. Many people say it's difficult to have option assignment. In my view, it's okay. Don't be afraid of option assignments. It's a great opportunity to buy your favorite stock at a good price. But for some reason, if you don't want to do that, you can always roll into the next strike, or a next month, or a next typically next month, and make some money that way also. And lighten up when the market is up big time. For example, you sell put options, you made some money, maybe 50% profit. You can take money off the table, so that way when the market drops, especially these days market is choppy, you have some money to buy or sell more put options. And typically, bad time to sell put option is after accounting scandal, or when the stock goes up exponentially. Avoid such scenarios, and avoid the stocks with a consistent deteriorating performance. It's not your worth the while. Even though IV percentile is high, don't fall into the trap. It's not worth your time or effort. And avoid options with a low open interest and high bid ask spread. You don't make too much money there. It's better to avoid those. And don't fall into margin trap here. Make sure you don't use up all your buying power. Maybe use 50% of your buying power, and keep other 50% as handy. When if there is some good opportunity, you can jump in. But I would say keep 50% of your buying power handy, so don't fall into the margin trap. And buy back the options when you reach 50% of the profit, so that way you got money to play the next day and take advantage of the market volatility, especially these days. All right, so let's look at what's the best time to sell put options. Look, one of the best time to sell put options is when the market is in a fear zone. As you can see here, right now we're in the fear zone. The fear index is 38. Typically, I sell the put options, in these favorite ETFs when we're in the fear zone or in the extreme fear zone, like right now. So you can make some good money during these situations. And when the market is in the fear zone or extreme fear zone, you can be more choosy. You can go after great stocks like maybe Apple, maybe Amazon, Tesla, and still you can make some good money. And you can sell put options on favorite ETFs like SPY, QQQ, SMH, and so on and so forth. And you can make some good money because market is in a fear zone. And there is a good people want to buy insurance when they are so much afraid, and they're not afraid to pay too much money or too much premium when they are in the fear zone. That's my favorite time. You could look at fear greed index from CNN, or you could also look at the skew. When the skew is really going low, that means there is extreme fear in the market, and that's when you sell some put options, make some money, and go from there. All right, now let's look at what is selling put options. So as you can see here, selling put options is an income strategy. You make some consistent money. Think of this way, right? So you bought a house and it's a rental property, and you want a rental income, maybe $2,000 every month. Think of something similar. If you have a, say, $100,000 account and you want to make some money off of your account, you could sell a couple of put options and make maybe say $500 on a monthly basis. If you have a $200,000 account, you can make around say $1,000 on a monthly basis. That's how I think about it. Don't overdo it. Do it in a consistent fashion. So how do I do it? So typically think of a stock which is about trading at about $40. That's the current price is $40 right now. So what you can do is, if you really like the stock, you could sell a put options at about $30. As you can see here, I'm selling a put option at $30. Current stock price is $40. Because I'm taking this risk here, I do it 45 days to expiration. I collect $2, as you can see here. I collect $2, and that's basically $200. 2 times 100, $200. I bring in $200 for taking the risk for next 45 days. I'm telling you, stock price is 40, but if it comes to 30, I will buy it from you. So because of the risk, I'm collecting $2 or $200, 2 times 100. So if the stock stays above $30 for next 45 days, that's my expiration date, I keep the entire premium of $200. If the stock comes below here, below 30, that's my loss zone, and 28 is my break-even point because I already collected $2. So 30 minus 2, 28, that's my break even. If it goes beyond, below my break even, I lose money. So that's how I kind of, explain this situation here. It's a good strategy. If the stock stays at 30 or goes higher, and goes much higher, you make the money, you keep the premium. But if it comes below 28, you lose your money. So that's why the probability of making money in put options, if you do it right, is extremely high. That's why many of these big guys, they always like to sell put options way deep below current stock price, and they don't want to make too much money. They just want to earn some rental income or something along those lines and really outperform the current market or S&P 500 index. So that's the best way. You buy some great stocks like Apple, Microsoft, and so on and so forth, and also buy some great ETFs like QQQ, SPY, and then on a consistent basis keep selling put options on conservative names like SPY, QQQ, Microsoft, Apple, Tesla, and so on and so forth, and earn some money. That's one of the best ways you can outperform these broader indices. So with that, let's jump in here and look at some great ETFs. When the market drops big time, like yesterday on this big news that Jerome Powell put forward, he has to take necessary steps. That's when I jump in and look at my favorite ETFs like SPY. Look at SPY here. Right now, IV percentile is 55. Anytime on these big ETFs, when the IV percentile is above, say 30, 35, that's when I sell some put options and make some money. So SPY, it's shot up big time here. That's when I sell some put option. QQQ also it shot up, and right now it shows 28, but it was higher yesterday. I sell some put options on this also, and then I don't go down the food chain when the IV percentile is too low here. But I look at even ARKK or Cathy Wood's innovation ETF here that also has a nice and high IV percentile. You could sell some put option here, and so on and so forth. So I also love selling put options on SMH, which is probably not here, right here, SMH, which is the semiconductor ETF. Look, IV percentile is 54. You could do that too. So with that, what we'll do is first we'll jump into Thinkorswim platform from TD Ameritrade and look at some of these, things and see how we can sell put options. All right, so let's jump in here. So I got here Thinkorswim platform from TD Ameritrade. Look, very quickly from a market perspective, we got market here, and market is trying to open up higher today, as you can see here. So when the market is opening up higher like this, it's a good story. It's coming off of this downturn here and trying to go higher. So all right, so now let's look at our favorite ETFs here and see what we can do. I will also go to a chart here and open up SPY to begin with. All right, so let's look at SPY here, S&P 500 ETF, as many of you know here. Look from a, oops. Let's quickly go here and look at this ETF here. So S&P 500 ETF, as we see here, right now implied volatility is 54.7. That tells you IV is pretty high at these levels here. All right, so IV is high, and if you see here, we got this implied volatility line. IV, it's also trending a little bit, flattish here with the high IV percentile. So what I will do is I will go here and look at the option chain. So I bring in SPY here. Typically, I tend to go maybe say 30, 35 days in advance. Here I could go to 29 April, which is 38 days in the future. I could go here, and as you can see here, I got implied volatility, I got probability of touch, like I was talking about earlier. So as you go down here, I go around, I look at the money that I can make here. See here, if as you look through here, it tells you the mark. Mark is how much premium that you'll get at this time. Typically, that's the midpoint. And if you go to 370, don't try to be a hero here. Around 15% is good enough, or even 13%. I would say this is good enough for me. I would sell a put option right here and keep watching the open interest. There's a lot of open interest here. You could even be conservative and go after a higher volume, higher open interest. This is good enough. We are not trying to be a hero here. You could just sell this put option here. You make $1.06. And typically I look at the midpoint. Even though it's saying 106, you could go to the midpoint. You get a good fill, and it could go 107. So you're bringing $1.07, which is $107. And you're basically telling, hey, you know what, if the stock, if the ETF SPY comes down to 370 by 29th April, I will buy it. That's why, because you're taking the risk, you're making $107. You could confirm and send here. If your break-even point is 368, it's hard to believe. I mean, anything can happen, but probability of SPY reaching 368 by this expiration date is very low. As you can see here, just 11% chance of SPY touching this 370 price. That's the risk that you're taking, and because you're taking the risk, you're earning $107. So it's one of the favorite strategy. You don't make great money, but a consistent income generator. And many people do it. As you can see here, open interest is too high. That tells you a lot of people are doing this strategy. So you could confirm and send. It's one of the good strategies here, and you can earn some premium there. And you could apply same methodology here. As you can see here, we got Cathy Wood's ETF here, which is ARKK, nice and juicy, IV percentile. I could go here and bring up ARKK. Look, ARKK here. So you could look at current stock price 63, and you could go here, and you could go around, say, 53 here, $10 down here. Look at the probability of touch. You're taking more risk here. I would not go here. I would probably stay at 50 here. So ETF price is 63. You could stay at 50 here. Probability of touch is 33% here. Not, it's pretty okay, not too bad here. You could sell a put option right here, and you could bring in midpoint here, 103, and you could sell it that way, 103, and boom, done. So typically, I don't like to sell on Cathy Wood's portfolio here because it's a little more risky for me. I would typically go with the QQQ as an example. If you look at QQQ here, so let's do the same thing here, 38 days out, and I would cancel this guy out here. And look, QQQ, this is more conservative, as you can see here. 13% chance you can make $1.11 here. I would just sell it here. It's a much bigger ETF, as you can see, QQQ, and I would say go to the midpoint here, 109, and just sell it that way. This is much more conservative compared to Cathy Wood's ARKK. You're taking more risk. So I would sell on a very good ETF like QQQ, bring in $1.09. In this case, $109, and I'm taking a risk for next 38 days or so. If the ETF comes down to 283, I don't mind buying it. It's a good price, but the chance of ETFs hitting that price is just 13%. I'm willing to take the risk, and I will confirm and send. So this is how I do it. So when the market drops big time, don't worry, sell some put options, make some money, stay above the current benchmarks like S&P 500 and so on and so forth. All right, so next let's look at stocks here. Typically from a stock perspective, I want to be a little more conservative. I want the volume more than 1 million shares. I want implied vol to be high. I want low RSI, positive net margin. I don't want companies that will belly up and explode on my face. I want conservative companies. I want positive sales growth. I want low debt. Let's look at such names here. And I also want big market cap companies. Look here, we got market cap all huge, big. These companies can't go under. These are very conservative companies. And look at the sales growth here. Nice sales growth. Almost very good sales growth. And net margin is positive. These companies are making money. So these are more conservative. And look at the IV percentile, nice and high, above 40, as you can see here. And look, they're all making you money in a 5-year time frame, or most of them are making you money. And they are doing very well. Look at the um, um, current ratio here. Many of them have got, all of them have got current ratio more than 1. They got enough money to take care of short-term obligations. So, if you take a look at this list, you could go down the chain. We'll look at one or two and then conclude. Look at Tesla here, top of the list. You might wonder, Tesla, $921 stock, what should I do? But look, we could take on Tesla here, no big deal. So I'll bring up Tesla right there. And, if you go to look at the Tesla here, let me go to a chart here. Tesla chart, as you look here, we got here price, current price is around 916, as you can see here. Let's see what's going on here. Let me TSLA. All right. So current price is around 921, and this looks like it's a good support level around 683 or so, as we see here. So I would go here to my option chain here, and I would say 38 days out is good enough for me. And if you have a lot of buying power, you could sell some put options way deep here, say at $500 as an example. Current price is 921. You're taking your strike price is expiration date is 38 days out. If you're a conservative, you could just sell a put option at say $500. A lot of people are doing it, as you can see here. A lot of volume here, and you could just sell here, and you get $1.34. That's your midpoint here. This is very conservative, 34. And there you go. Your buying power effect is $5,000, as you can see here. And one of the conservative strategy, if Tesla comes down to goes below 498 by next 45 days, you will be in the loss zone. But if it stays above 498, you're breaking even. If it stays above 500, you get to keep entire $134. It's one of the conservative strategy. You could confirm and send and go from there. So other way you can also do is you don't want to take so much risk, but you want to still make money. So what you could do is you could go around, say, 650 and 600. You could sell the spread. So as you can see here, I go to 650 and I right click here and go to vertical spread, and I sell. I sell at $600. Actually, I'll do other way around here. I will sell at 650. Let me actually go here and sell 650. I'll just say sell and vertical. There you go. So I'm selling 650, as you can see here, and I'm buying back 600. I'm taking a $50 risk here, and as you can see here, a chance of hitting $700. I mean 650 is 17%. Chance of hitting 600 is 11%. So I'm taking a $50 hit here in Tesla, and I mean risk here, and for that risk I'm collecting $2.67 here. I confirm and send. My break-even point is 647. If Tesla next 38 days, if it comes below 647, I'm willing to buy it. So for the risk I'm taking, I'm bringing in this much money here, which is as you can see here, I'm bringing in max profit of 267, and buying power effect is 4733, 4733. It's good enough for me. I would confirm and send and go from there. So you could look at same thing on the other stocks here. I got some of the favorite stocks here: NVDA, Facebook, or Meta, and so on and so forth. You could apply same methodology here and make some consistent income. Don't overdo it. Just if you have a $100,000 account here, you could you could make around $1,000 on a monthly basis. If you have $200,000, you can make around maybe say $2,000 on a monthly basis. That way you stay above the water and stay above the benchmark. So with that, thank you very much. Happy investing and trading. Please subscribe.